Nasdaq just filed with the SEC to let you trade tokenized stocks, real stocks, Apple, Tesla, Amazon, on a blockchain. And here's the thing nobody's talking about. The Federal Reserve just published a paper saying a betting platform run by a startup beats Wall Street economists at predicting their own rate decisions. So I gotta ask, is traditional finance quietly building the infrastructure to tokenize and predict everything? Let's get into it. So here's what actually happened. On September 8th, 2025, Nasdaq filed what's called SR Nasdaq 2025-072 with the SEC. And this is genuinely a first. No major stock exchange in history has ever done this. They're asking permission to let investors trade tokenized versions of real equities. Russell 1000 stocks, US Treasuries, major ETFs, on a blockchain. And look, we're not talking about some synthetic derivative or a wrap token. Adena Friedman, the CEO of Nasdaq, was very specific. She said, and I quote, "We are tokenizing the underlying equity, not a derivative of the equity." Now here's what makes this actually fascinating. And honestly, most people are completely missing this part. The headline is about tokenized trading, right? But the real play, the actual reason Nasdaq is doing this, is collateral mobility. Think about it. Friedman herself said, quote, "There's just so much capital trapped, whether it's in clearinghouses or clearing brokers. We're talking about trillions of dollars just sitting there, locked up in the plumbing of Wall Street. Tokenization lets that capital move instantly, programmably. And the blockchain they chose? Not Ethereum, not Solana. It's called the Canton Network, a privacy-focused permission blockchain built by Digital Asset. And here's the kicker. That company is backed by BlackRock, Goldman Sachs, and Citadel Securities. The biggest players in traditional finance are literally funding the rails that their own stocks will trade on. Now, I want to be real with you because the skeptics make some fair points. SIBO, one of Nasdaq's competitors, formally opposed this filing. Their argument? The SEC should wait until the settlement infrastructure is clearer. And ESMA, Europe's regulator, warned that some tokenized stocks don't even give you voting rights or dividends. So there's a legitimate question about what exactly you're buying. But here's the stat that made me sit up straight. Tokenized equities went from $32 million in market cap to $963 million in a single year. That is a 2,878% increase. And this is before the institutional infrastructure even launches. The market nearly hit $1 billion and almost nobody noticed. Before I get to the next story, quick question for you. Based on what we just covered about Nasdaq tokenizing stocks, do you think this actually changes anything for the average investor? Or is this just Wall Street repackaging the same system on fancier tech? Drop your take in the comments before you hear mine. Now, speaking of Wall Street and blockchain, let's talk about the headline everyone's been sharing. Wall Street giants led by BlackRock and MasterCard eye XRP ledger. Sounds massive, right? And yeah, there's real stuff happening here. But let me give you the honest breakdown. So what's actually confirmed? MasterCard, Ripple, and WebBank are running a pilot to settle credit card transactions using Ripple's RLUSD stablecoin on the XRP ledger. If that works at scale, we're talking about compressing multi-day clearing cycles into seconds for the $20 trillion global card payments market. That is legitimately significant. Franklin Templeton deployed its money market fund token on XRP Ledger through DBS Bank. They're actually building tokenized repo markets on this thing. And honestly, if you understand how banks manage overnight liquidity, that might be more important than any ETF. But here's where I need to keep it real with you. The BlackRock connection? It's indirect. BlackRock's BUIDL fund is not natively on XRP Ledger. It gets there through Ondo Finance's OUSG wrapper. And that quote-unquote interest confirmation? It came from an XRPL Commons director at a conference, not from BlackRock or MasterCard themselves. There's a real difference between expressed interest and signed partnership. Now, the bigger picture here is actually Ripple, the company. They spent $2.7 billion in acquisitions last year. Hidden Road for prime brokerage, $3 trillion in annual clearing, G Treasury for corporate payments, 12.5 trillion in volume. They're not just a blockchain project anymore. They're building a parallel financial operating system at a $50 billion valuation. So yeah, the headline is directionally true. Wall Street is looking at XRP Ledger. But looking at and building on, those are very different verbs. And with XRPL's total value locked at roughly 100 million versus Ethereum's 97 billion, there's about a 1000x gap to close. So here's where things get genuinely wild. And honestly, this might be the most underreported story in finance right now. The Federal Reserve, not some crypto blog, not some random analyst on Twitter. The actual Federal Reserve Board of Governors just published a paper about Kalshi, the prediction market. The paper is called Kalshi and the Rise of Macro Markets. And what the researchers found is kind of jaw-dropping. Kalshi has a, quote, perfect forecast record on Federal Reserve rate decisions since 2022. It beat both professional surveys and Fed funds futures. And for CPI predictions, Kalshi's forecast error was 40% lower than the entire Wall Street consensus. Think about what that means. A platform where regular people put money on what they think the Fed will do was more accurate than rooms full of PhDs with Bloomberg terminals. The researchers even recommended using Kalshi data to build what they call risk-neutral probability distributions for FOMC meetings. In plain English, they're saying the Fed should use prediction market data as a formal input for policy decisions. If adopted, that would be the first time a central bank officially incorporated betting market data into its monetary policy framework. That is a paradigm shift. But here's the part that made me do a double take. You know what 89% of Kalshi's revenue actually comes from? Sports betting. Yeah. The paper is titled The Rise of Macro Markets, but the actual business is mostly people betting on the Super Bowl and NBA games. They pulled in $263 million in revenue last year, up 994%, and the overwhelming majority is not from predicting Fed decisions. Still though, the signal here is unmistakable. Kalshi's valuation went from 500 million to 11 billion in a single year. Susquehanna, Citadel, and Two Sigma are making markets on this platform. The Fed's own economists are singing its praises. We're watching a betting app become financial infrastructure in real time. So look, here's what I want you to walk away with today. Nasdaq is tokenizing stocks. Ripple is building institutional plumbing. And the Federal Reserve is studying betting markets as policy tools. 3 years ago, all of this would have been dismissed as science fiction. And yet here we are. The question isn't whether traditional finance is adopting this technology anymore. It already is. The question is, who controls the rails when it's done? If this gave you something to think about, smash that subscribe button. Drop a comment and tell me, which of these 3 stories do you think matters most for 2026? And if you know someone who needs to hear this breakdown, share this video. I'll see you in the next one.